Joining us now is Langan. He's an equity analyst at Wells Fargo Securities. Colin, good to see you, and connect some of these dots for us.
Yeah, I mean, I think there's really two factors here. One, there's a slight direct impact from the SVB situation. The FinCos of the auto companies are going to be under a bit of pressure. We've seen a more choppy ABS market, and that's a significant source of funding for them. There's also a risk that the cost of that funding may go up. I think the bigger piece is that the macro concerns here could drive, lending spreads up a bit. And that's going to put what's already, in my opinion, significant pressure with rising interest rates. We're already going to see more pressure on new vehicle pricing. I mean, customers shop for their payment. And with higher rates, and now maybe even higher rates because we're taking a higher risk spread, that means a lot of pricing pressure on the auto companies. That's been a huge driver over the last 3 years. I think if you look at the walks, it's like $17 billion of help since COVID. And some of that, I think, will start to unwind as we go through the year.
And, I mean, you're not sort of pulling any punches here. You've got an underweight on both Ford and GM. So you've kind of described the characteristics that have you worried about autos a little bit more broadly. But what is it in particular you think that's going to be a catalyst here for these stocks? And again, we've already seen Ford, they have, a lot of expenses as they're trying to ramp up their EVs and all the rest of it. How much more of a headwind will this be?
I think there's, unfortunately for the automakers, a lot of negative catalysts this year. I think pricing is going to unwind. I think that's very likely. I mean, we've never had a supply situation like we've been in before, but I think as supply recovers, which probably happens in Q2, pricing will start to normalize. And we've already seen some signs on the edges that pricing and incentives are starting to creep up. I think that's clearly the biggest near-term headwind. But just this morning, we did an update on the UAW contract that'll be coming up in September. Labor inflation is huge across the country. We're expecting, I think, as a baseline, a 10% wage increase. So that's pretty meaningful. That could be $1 billion in added costs for both GM and Ford into next year. So it's something that I don't think investors are paying enough attention to. I also think that contract is going to be very contentious, very high chance of a strike risk. We saw that in 2019. When you're looking for pretty big wage increases, you have very likely new leadership at the UAW, very likely chance that we're going to have some form of strikes in the fall. Another pretty significantly negative catalyst for the group. And then on top of that, I think on a long-term basis, you mentioned electric vehicles. I think the economics there are very, very challenging. I mean, even just yesterday, Ford was talking about how they're losing, they have a negative contribution today. They expect it to be break even by the end of the year, but it's pretty negative when every car you sell is losing a bit of money.
Yeah, no, and it's for those of us who remember kind of that period in 2005 where, when we talk about CDS, remember when it was Ford and GM, and it was like, I never like to say, and the market has this memory where it says these events may have nothing to do with each other. They're totally different companies now, and yet you just don't like to see these two major automakers going through any period of financial tightening. So all of that said, you are overweight on names like BorgWarner, for instance. Where do you still see opportunity, and why don't you think necessarily this year will be as bad as what we went through in the financial crisis?
Yeah, I mean, I think from where I do see opportunity is I actually think pricing comes down quite significantly, but I also think volume comes up. There are a lot of people who have been waiting because there is pent-up demand, right? We haven't been able to deliver cars, so we never really had any full recovery post-COVID in the auto sector. And that's great news for the auto suppliers. So that's why we like BorgWarner. I think it's a compelling valuation, a great long-term story as they're actually becoming an e-powertrain leader, and that's going to be a growth opportunity for them. And just like all the suppliers, if production is up, their sales are going to be up. So that's going to be a key driver.
That's a great point. And that would certainly be a much more encouraging landscape, even if it's a headwind for some of the automakers themselves. Colin, thanks for your time today. We appreciate it.